Welcome to the Bell Equipment Interim Results presentation for the 6-month period ended 30 June 2025. I'm Ashley Bell, Group CEO, and I'm joined by our Group CFO, Karen van Acht. I'm going to run you through a brief overview of the operational highlights, and I will then hand over to Karen to take you through the financial performance for the period. I'll then close out with a high-level recap of our strategic focus areas going forward. Following the market cycle downturn seen during the 2024 year, which kept us on our toes, we were optimistic that our markets might regain some stability during 2025. However, this year is not panning out as expected. We have experienced pleasing demand from isolated markets and sectors, particularly mining in South Africa and Zambia, which has been helpful in offsetting very subdued market demand from the Northern Hemisphere. The USA tariff situation, which became a harsh and abrupt reality during April this year, resulted in uncertainty in that market and made our production and sales planning extremely challenging. Furthermore, exchange rate volatility associated with the geopolitical instability we have seen adds to the challenge. We have remained focused on driving sales vigorously across our global markets, on cost containment and cash preservation, as well as process improvement to enhance both operational efficiencies and quality. We will now move on to an overview of our South African OEM operations, which includes manufacturing, logistics, and sales to dealers. Sales from our South African factory to external dealers during the period decreased by 15% compared to the same period in 2024. Due to a reduction in production volumes through the factory, including ADT assembly kits supplied to our factory in Germany, there was a very sharp reduction in operating profit in this operation. Due to lower factory production volumes, operating inventory reduced, resulting in a net cash positive position. Southern Hemisphere ADT dealer demand collectively, including Bell-owned dealerships in South Africa and Zambia, remained relatively stable. Whilst a small part of our business, we have seen a pleasing uptick in demand for our forestry and agriculture products since the start of the year. We expect commodity prices to remain under pressure, particularly due to the current geopolitical uncertainty, and we are concerned that market competition in the second half of the year will be a lot tougher. We have had all hands on deck with the start of production of our new motor grader product. We are rolling the product out in a controlled fashion, focusing on Southern Africa initially, but we remain extremely excited about the growth potential that this product offers us over the coming years. However, with that said, the imposition by the USA of a 30% tariff on products manufactured in South Africa presents a major hurdle for our South African factory and business. Onto an overview of our European OEM operations, including manufacturing, logistics, and sales to dealers out of Germany. External sales from the OEM operation in Germany reduced by 22% during the period, compared with the same period up to June 2024. Our factory in Germany supplies product to the USA, and with the implementation of tariffs, there has been a pause in shipments and in market sales to some extent. Due to the impact of the weaker US dollar to the euro, coupled with lower production volumes through the factory, operating profit in this operation also reduced compared with the same period last year. The lower production volumes also resulted in a reduction in operating inventory and necessitated the implementation of a workforce right-sizing exercise. We have been encouraged by an uptick in demand evident in the UK market. However, demand from the rest of the European region has been relatively flat. We expect Northern Hemisphere markets to remain extremely challenging, particularly the USA, but we are cautiously optimistic that we will begin to see a positive turn in European market demand towards the end of 2025 and through 2026. Due to lower demand and factory production levels, we have implemented a short-time working week at our factory in Germany, and we expect this to remain in force into next year. Our strategic project to grow our manufacturing capabilities over the next few years in Europe closer to suppliers and Northern Hemisphere markets is ongoing. Moving now on to our direct sales operations in South Africa and Zambia. Both BESA and Zambia had a pleasing start to the year, with positive demand for ADTs and some of our complementary third-party product lines that we represent in these markets. This was largely on the back of new mining expansion projects, particularly in Zambia. We saw a considerable reduction in finished goods inventory during the 6-month period, which was brought more in line with targeted levels at 30 June 2025. The third-party product lines that we represent through BESA, namely JCB, Cabalco, and Finlay, remain a good fit with our OEM product range and ensure that we can offer our customers full-line solutions. We remain optimistic that certain mining sectors will continue to support demand for equipment, but we require greater momentum in South African infrastructure spend for the construction sector demand to reach its full potential. A key focus for these dealership operations is the sales launch of our new motor grader product line. Our order book is filling up, and we are well positioned in the market with this premium product offering. We have seen greater competition from Chinese players in these markets, and we need to ensure that we continue to sell our premium brand promise, service excellence, and ensure a positive customer experience with every engagement. I'm now going to hand over to Karen to run you through the financial results for the period.
Thank you, Ashley. Revenue and operating profit. Revenue for the 6 months of 6.1 billion rand was down 4% compared with the first half of 2024. This exceeded our expectations, given that the market conditions at the start of 2025 were generally weak, and that this was followed by the US tariff announcements in Q2 of 2025, which further slowed down demand from the US market. The decision made with the group's US distributor to continue with the planned production volumes for the US, to enter into a bill and hold agreement with extended payment terms, and to delay the shipment of machines to the US while awaiting the announcement of the rate of tariffs meant that sales invoicing continued during this period of uncertainty. This had a favorable impact on revenue and on profit for the period. The sales performance in South Africa, Zambia, and the UK was also pleasing and offset some of the impact of subdued demand in the Northern Hemisphere markets. Lower production volumes was the main driver of the 42.5% reduction in profit from operating activities in the first half of 2025 compared with the first half of 2024. Inventory right-sizing efforts and aligning production volumes with slower market conditions resulted in lower recovery of the fixed expenses at the group's factories in both Richards Bay and Eisenach-Kindl, Germany, and this has a negative impact on the bottom line. Both revenue and profit from operating activities were, however, up on the second half of 2024. Earnings and headline earnings per share. EPS and HEPS were down by 30% and 23% respectively on the first half of 2024. A reduction in the interest costs as a result of lower debt levels meant that EPS and HEPS did not reduce to the same extent as the operating profit did. Foreign currency gains and losses. The group's approach to the management of foreign currency risk is to match currency inflows and outflows as far as possible, to use natural set-off, and then to take out forward cover on the majority of the residual currency risk. The group has exposure to the US dollar, euro, British pound, and Japanese yen. During the first half of 2025, the main currency challenge for the group was the weakening of the USD against the euro. Sales to the US from the German factory are in USD, and the weakening of the USD was the main driver of the 74 million rand net forex loss in the period. This also had a negative impact on the operating profit of the European manufacturing segment for the period. Balance sheet, assets, December 2025 compared with December 2024. The group obtains independent valuations on its owned land and buildings every 3 years, and 2025 is a valuation year. A revaluation surplus of 65 million rand, mainly on the Richards Bay properties, was accounted for in equity during the period. The valuations of the owned properties in Germany will be completed in the second half of the year. Intangible assets reduced by 8% due to the impairment of development costs of 33 million rand. This related to the decision not to pursue an underground division and to rather focus on the group's traditional markets, as previously announced, and to the track carrier, which is manufactured at the Richards Bay factory solely for the US market. The track carrier has suffered a setback with the introduction of US tariffs, and we have taken a conservative approach and impaired the capitalized development costs on this product. Inventory decreased by 12%, or 587 million rand since year-end, to 4.5 billion rand. This was mainly the result of the reduction in complete machine inventory. A more detailed breakdown of the inventory is provided later on in the presentation. Trade and other receivables increased by 30%, or 400 million rand since year-end. The extended terms provided to the US distributor on the bill and hold machines contributed to the increase in trade receivables. Almost all of these bill and hold machines have subsequently been shipped by the distributor to the US, and approximately 90% of the trade receivables balance has been collected since half-year end. The reduction in working capital freed up cash, and the group ended the 6 months in a net positive bank balance position. Balance sheet equity and liabilities, December 2025 compared with December 2024. The main change relates to the reduction in debt in bank overdrafts and call loans, and also in interest-bearing liabilities in the 6 months. The reduction in working capital was the main driver of these cash inflows. Trade and other payables increased by 46% since year-end. There has been no significant change in supplier payment terms. The reduction reflects that purchasing levels have stabilized to match the lower demand and production volumes after the initial reductions in purchasing to right-size inventory. Income statement, June 2025 compared with June 2024. Revenue of 6.1 billion rand was down 4% on the first half of 2024. The GP percentage has held up well at 21.9%, compared with 21.1% for the first half of 2024. Changes in market and product mix are the main reasons for the improvement in GP percentage, despite the tougher market conditions. Other operating income reduced by 24%, mainly due to lower incentives earned in South Africa on the production-based automotive production development program, due to the lower production volumes this year. The high increase in expenses of 19% compared with last year was mainly due to lower capitalization of labor costs and other expenses to inventory, due to lower production volumes this period. The lower borrowings resulted in the group being a net earner of interest for the current period. This had a positive impact on the bottom line. Notes on inventory. Total group inventory reduced by 12%. Manufactured and third-party machine inventory at year-end was high and has been sold down, reducing by 36% and 22% respectively since year-end. The investment in used machines has increased by 59% and will be a focus area in the second half of 2025. Cash flow statement. Net cash inflow was 487 million rand for the 6 months, mainly from the working capital reduction. Net debt and finance costs. Debt reduced and the group was in a net positive bank balance position at half-year end. Interest cover increased due to lower debt levels and lower interest charges. Segmental revenue. The owned sales operations in South Africa and Zambia increased revenue by 18.5% and 12.7% respectively, compared with the first half of 2024. Sales in South Africa comprised a higher proportion of group sales in this period at 41.9%. External sales from both of the production facilities in Richards Bay and in Eisenach-Kindle were down on the comparative period. This was due to weaker demand from Europe, Australasia, and the US. Segmental operating profit. The most notable decrease in profitability in the first half of 2025 was in the OEM operation in South Africa, which is within the SA manufacturing segment. This was mainly due to lower production and sales volumes of complete machines and kits from the Richards Bay and Eisenach-Kindle facilities. As the OEM operation, this entity carries the major impact of the demand cycles. When market conditions are strong and production and sales volumes are high, this entity performs well, and the opposite is true in a down cycle. The operating profit of the manufacturing operation in Europe was affected by slowed demand, mainly from the US, and by the weaker USD. We were satisfied with the operating profit performance of the dealerships in South Africa and Zambia. Thank you, Ashley.
In closing out, I just want to recap some of our high-level strategic focus areas. It is important that I emphasize the extremely volatile and uncertain market conditions that we are operating in, and as such, we are taking a very cautious approach for the remainder of 2025 and into 2026. The USA is the world's largest ADT market and one of strategic importance to our volume growth going forward. The imposition of tariffs in this market is a setback for the industry, and we expect to feel this pinch during the second half of the year. We are monitoring the situation, and we will carefully adjust plans as required. Manufacturing in the USA is not something that can be switched on overnight, and it will take years for supply chains to be established in this market. We continue to work with our global dealer network to pursue growth opportunities through support and development strategies. To stay relevant in this fast-paced world, IP generation through new product development and enhancements to our existing products remains critical. We're exceptionally proud of the world-class product that we have created in our new motor grader, and the ongoing rollout of this product to Southern African markets for the remainder of 2025 is an immediate priority for the business. Growing our lifetime revenue stream business, which includes spare parts and services, is a key contributor to the performance of our business and remains a focus. Our strategic project to expand our ADT manufacturing capabilities in Europe over the next few years is tracking to plan, and coupled with this, our engagements with various potential customers for our contract manufacturing services in Richards Bay are ongoing. Lastly, we continue to build the resilience of our team through the rollout of our internal development program called Building Us Stronger, empowering each and every team member with a renewed sense of pride, energy, and commitment for each other, our business, and our customers. This brings us to the end of our presentation. Thank you for taking the time to listen to the recording, and thank you to all of our stakeholders for your ongoing support and commitment to Bell Equipment.